So we're going to get started, everybody. I'm going to start off with saying that the headline on CNBC right now is "Mortgage Industry on the Brink of Complete Chaos," which is a headline that stems from an interview that they did this morning with Jay Brace, President and CEO of Mr. Cooper, formerly NationStar. And in that interview, he says that due to the uncertainty and due to the fact that there's no plan in place, there is complete chaos happening in the secondary market in the mortgage industry right now. Giving everybody a little bit of a backlog with what happened at the end of last week, we saw Wells Fargo come out and announce that they're no longer going to be purchasing jumbo loans in the correspondent and servicing market. We saw Wells Fargo raise their minimum credit score on government on the correspondent side to 680. And we saw New Res come out and say that they are stopping all activity, whether it's acquiring, servicing, buying correspondent loans, wholesale loans for the next 30 days. And then PennyMac gave a directive to their clients, whether it's Minicore or brokers or even people they buy servicing from, letting them know that if there is a forbearance request before the first payment, that will result in a buyback or an EPO. And I shared a little bit earlier today saying that the expectation for all mortgage brokers needs to be that we're going to see announcements from our wholesale lending partners very soon that says that if there is a forbearance request prior to the client making their first payment, you can expect an EPO. This won't be retroactive. It won't be backward looking, but my expectation is April 1st or April 15th going forward on any loan that funds after that date. That's going to be something that, you know, the third-party origination world is going to be dealing with. So we have Gary Mouse, Chief Strategy Officer, Chief Capital Markets Officer from PRMG. We had him on a little bit earlier. We had some technical issues, but we're going to get restarted. And we're going to start with the forbearance for all has been rocking the market. First, it started out as a liquidity issue. Now we're dealing with, you know, how this is impacting all the players in the market. So where do we get started on what you're seeing from some of these aggregators that are pulling back in a big way?
No, well, let's try to unpack your opening sentence. And again, I apologize if it sounds stale since we just did it a little while ago, but I think we kind of have to start over. All a couple weeks ago, everyone had been talking about liquidity in terms of forbearance requests. And everyone was concerned about it from a servicing standpoint, right? In terms of not so much the MBS or the cash price that you delivered to the agency, but really just the servicing strip and performance of that servicing strip, which was in itself a very difficult question. But what's happened recently is because of the language from Fannie and Freddie as it relates to what forbearance means, and you get into a difficult legal question as to when can forbearance begin? And so let's kind of walk through a timeline, then we can walk through the challenges this creates. So if you're a mortgage broker, and even if you're someone like us, right? Let's say a loan funds at the end of March and your first payment is May 1st. What Fannie Mae basically said is in their FAQ, and you can read it, it's public information. It's, you know, COVID-19 response FAQ. And question number 16 says, can you deliver a loan in forbearance to Fannie Mae? And it just says no and no. Doesn't say anything else, just says no. And so you get into this question of, well, what does in forbearance mean? Does it mean a customer just called and said, hey, Anthony, I have some questions about forbearance. I read about it in the paper. I just want to know about it is. Oh, okay. Thanks for telling me. Is it a formal request? Can you even be in forbearance if you haven't had a payment that's due yet? Meaning if your payment's due May 1st on a note, can you even have forbearance in April? And so what's happened is everyone was so focused on servicing and performance and delinquency, kind of as an aside, everyone just realized, well, wait a sec, I don't know if we can deliver loans to Fannie Mae or Freddie Mac right now. And so that's what you saw in this last couple of days. And so when you mentioned, the information about Penny Mac, and I'm really careful never to mention names in terms of companies, just because I don't want people to get the wrong. I have friends at Penny Mac, I have friends at New Res, I have friends in most companies. And what people do sometimes is the right decision, even if they don't understand it or get it. And what they essentially said is, and you can take their name out of the equation, they said basically when we purchase a loan, if a customer makes a forbearance request after we purchase a loan within 15 days or when we purchased it, it can still be a repurchase. So when you think about that for a company like us or any normal independent mortgage banker, when you fund a loan on a warehouse line and you're advanced at 98%, so you're essentially borrowing 98% and you're funding 2, 3, 4% of what they call a haircut, you deliver the loan, it gets purchased, you get replenished that 3, 4, 5%. If you sell a loan to someone and then 10 days later they ask to repurchase, there is no warehouse line, which means you went from a 2% advance to literally 100%. And it means any loan that someone funds, if they really can't put it into a security, That's not a servicing issue. That's not 1% of a loan amount. That's the entire loan amount. That is by definition a 100-time size liquidity event. And so this lack of clarity from Fannie and Freddie as to what forbearance really means. And the MBA, bless their hearts, are trying desperately all weekend long to try to get clarity on this. Everyone's talking to the right people. And I don't even know if Fannie and Freddie knows what they said or didn't, meaning this may not be on purpose. They may have been accidental. It may have been they're thinking, hey, wait a sec, this is not what we meant. But there is general confusion right now. And if you think about it from a timeline standpoint, it gets really complicated because depending on whether you're a broker, an independent banker, whether you're an aggregator, it's all about this life cycle from when a loan funds. And let's take off the table your earlier comment about whether they ask for it even funds, because theoretically, if they ask before it funds, one should argue that it shouldn't fund because you now have been given an impairment that suggests they're not ready to make this payment. And you get into a whole different moral question as to whether you should or shouldn't fund that ask. But let's presume they haven't asked till after funding. And now you have this time cycle, a loan at the end of March. Well, if you're a PRMG and we choose to send that loan to Fannie Mae, plus or minus, we can do that in 4, 5, 6 days. If we pool the loan, it might take a little longer depending on what our process is. If we use an aggregator, and let's say we ship a loan to an aggregator, whether it's Penny Mac, you can name plenty of good aggregators out there. They're going to take X number of days to review the file, plus what we took to ship the file. Then they're going to purchase the file, and then they're going to securitize that file. So let's say that timeline is 20 days versus 5 days. It's really true that in those 20 days, somebody can ask for forbearance and be considered in forbearance. That is a 20-day cycle that tells people they should not buy an asset because they can't guarantee delivery into a securitization, which puts them at peril. And then you get into this ugly cycle where people are now trying to say, well, we told you independent mortgage bankers didn't have enough capital. It's like, well, no one has enough capital for the GSEs not buying assets. Like, it's just a silly comment, right? And me and you privately talk all the time and I use my analogies, and I'll give you the other analogy, right? I'll give you my rock concert analogy, right? If all the parents get together to try to avoid a rap concert and say, look, we're gonna give all our kids, we're gonna give them all some kind of laxative. So they all have to go to the bathroom all at the same time. And 20,000 people have to go to the bathroom at the exact time. That concert stadium does not have 20,000 stalls, but you can't be mad at the place for not having 20,000 stalls. No one's built for everybody to go to the bathroom at the same time. Like, it's an unfair attack. And so what's happening now, unfortunately, is while this is a legitimate problem where the government is trying to help consumers, as they should, but because they didn't work in concert with everybody, we have people not sure what they should do. And then it's quick for people on Monday morning to say, oh, they don't have enough capital for this. Again, nobody would. I don't even know that the banks would have enough capital for this. Now, clearly they have more because they have a lifeline built in through depositories and through federal ability to get liquidity. But no independent mortgage bank has infinite capital. That is a true statement. So if that's what people want to say, they can say that. But nobody contemplated a world where the GSEs would actually say, even in a 5-day or 6-day cycle, you couldn't put a loan into a security. So this moment in time is much different than the whole debate that's been happening for the last 2 weeks, as you and I have discussed, all about servicing values. Forget about rate teach. Forget about trying to figure out the difference between mortgage-backed securities and the cash window and default servicing costs and cash flows and what the Ginnie participation program is or isn't. This is a whole new level of confusion that I suspect will get cleared up very quickly. But if it doesn't, it is tricky for anyone to really buy an asset right now. And so anyone who is be defensive right now, this isn't a time to say, ooh, they're out of cash or, ooh, they have big problems. It's actually them probably being pretty responsible and saying, look, our time cycle here puts us at risk and we're not quite sure what to do given this. And we need the FHFA and others to clarify this specific legal question. And it's vital that they do.
So that's a good point. And I think that's been a big part of the narrative for the last week is we've seen, whether it's lenders adjusting their credit criteria, whether it's them adjusting their processes from a VOE perspective to add a VOE at a later point in the process. This has been a constant point of, both frustration and also, dialogue. And I guess the big thing right now that a lot of people don't understand is that it's not from the day of funding that things are, kind of consummated. It really comes down to how long does it take the funding, the lender who's funding that loan to either securitize the loan or sell it to an aggregator who then securitizes it. And then from that point, as you said, the lack of clarity is, okay, once the forbearance gets requested, is it before the first payment, securitization, what is acceptable, what's not acceptable. But as of right now, because there's a lack of certainty or lack of direction, it's causing people to say, hey, we're taking a position that if a forbearance is requested before first payment, all bets are off. Broker, you're paying EPO, or whoever sold it to us, you're getting a buyback. That's kind of the current way people are reacting.
Yeah, and quite frankly, you can't blame them. In other words, you can't, again, if someone wants to say it's a penalty to have a limited capacity in capital, you also then can't get mad at them for doing the prudent thing to actually properly protect their capital. And if you're in a position where you're funding loans, now again, I think it's both understated and overstated all at the same time. Meaning it is just a window, right? Theoretically, if everyone's doing their job from all the way from the loan officer to the broker and everyone, and by the time a loan funds, we have reconfirmed. And that's why you're seeing companies getting very intelligent about doing a VOE on the final day. And you see some people, I think, and again, we don't know names, but again, I think United Wholesale is one of the first to come out on the last day of funding, literally the day of funding. And people said, oh, what is that? It's like, well, can you blame them? What they're trying to do is shorten that cycle of predictability that says when you fund a loan, I have confirmed you are less than likely to ask for forbearance from the time that loan funds till when I can responsibly place that into a Ginnie Mae or Fannie Mae securitization. Right now, whether you do that directly or you do that through an aggregator, you have a responsibility, knowing what you know, to keep that cycle as short as you can. But also, you have a responsibility to fund a quality loan. You can't ignore. In other words, I don't want people to hear this and think, oh, so you're just trying to get it through quickly and get it to Fannie and Freddie before you get caught. No, the truth is that's why you're seeing so much stringent issues being done now, even prior to funding, because this verification of employment is vital, because in a Fannie Mae guideline, there is a responsibility in the guidelines for continuity of income. So it is on the lender to say responsibly, look, we could have even seen this forbearance. And so in theory, you shouldn't even fund an asset if you think the odds of forbearance are super high. And so it gets tricky even prior to funding. Then you get into the cycle, and that doesn't even get into the cash flow and all the complications to, if they do get forbearance, what kind of cash impact you have, whether you're Fannie, Freddie, Ginnie servicer, and what happens with forbearance. So up until this week, everyone had been focusing on forbearance in terms of servicing and in terms of delinquency and in terms of cash flow modeling and what the advances would be. And that is an important question, and that's no less important. It's just for the most immediate time, we just need clarity on this one piece. And again, depending on who that is, that cycle is going to be longer or shorter. So for example, let's say you have a correspondent, and you mentioned New Res earlier. I think they're a great organization. But let's say they get so much volume that they're going to take a while to review a loan. Let's say the broker funds a loan. And let's say with us, and we ship it to example like New Res. And let's say they're behind. And let's say it takes them 18, 19, 20 days to review an asset. Well, that is a time window that is creating an opportunity for a customer to read the newspaper and make a call that they may not have made till later. Now, theoretically, that's not fair to New Res either way, because bottom line is they're still going to be responsible as a servicer to deal with the forbearance. But if the issue is they can't put it into security, then it puts us both in a gridlock, because we look at them, they look at us, and we say, well, should we buy this loan? Well, we already funded the loan. Someone has to buy the loan, but where can we place it? And so that's why this FHFA clarity that the MBA has been working tirelessly on. I mean, I've been texting them all weekend long. You got a whole team over there that gets it. But it's tricky, because between hearing about advanced liquidity and hearing about MBS control and not buying too much treasury, like every day someone's going to the government and saying, hey, look, you're fixing one thing, but you're creating another problem. And so you have to understand that every time you make an action, there is a reaction, and you need to talk to the industry as a whole, not just the banks, not just the independent banks, not just the consumers. You need everybody working together here, because if this doesn't become a public-private solution, someone is going to be on the short end of the stick. That's just the reality.
So with that said, I mean, like if we really walk through that equation where, the wholesale lender is trying to do their job with the continuity of income, verify employment as close to the day of funding as possible, then they are selling it to an aggregator. The aggregator is then doing the same exact thing. But at the end of the day, whether it's a week, 2 weeks, a month, the risk that is currently posed in the market, because every week 3 to 6 million people are losing their jobs because the impact that we're just seeing overall. If this just comes to a place where inevitably somebody's going to get stuck holding the hot potato, then things like what New Res did make sense, which is New Res basically said, we're out. Lakeview, same thing. We're putting a 30-day. We're not bringing in any more loans from any channel because we need to figure out what exactly this is before we can put ourselves out there anymore.
Yeah, and I can't speak. Both those companies have great people running for them, and I can't speak for them specifically. But again, if you are an entity, and again, this takes out all. Remember, think of the noise you've been covering on your show between Barry Habib and Dave Stevens and others. Look, last week it was a margin call crisis, right? Well, that margin call hasn't gone away. It's not like that money has gone into Vaporland. There are still trades out there that are out of the money, which means there are loans that are in the money that need to close and fund. And so there's an urgency to close a pipeline. And you have to close this pipeline against this moving issue of servicing values dropping to zero or negative, to trying to confirm that these people actually make their payment and they have a job, to the issue of now whether you can place them into security. And so if you're a lender, you may say, look, I have too many things to deal with at once. I'm just going to put a pause because, quite frankly, I need to get the loans purchased right now that I have in my pipeline. And I only have X amount of capacity. Because the other issue may be is, we're so quick to say, oh, this company's in trouble. Oh, they're getting rid of risk, or they're defensive, or they're out of cash. It may be they're just saying, look, I just need to fund and sell what I got because my service levels are going to become an atrocity. We're ignoring that everyone has transitioned back to home. People have relied heavily on other countries. There are some people that did not do as well in India from transitioning to home. There are some banks that won't allow people to work from home in India based on their privacy policies. And so you have an entire purchase centers that have shut down. And so some of this may be as simple as, look, given the risk and given the amount of volume we have at record volume, we just need to get what we have right now and let some of this get sorted out legally, and we'll go right back into it. So they may not be in trouble at all, quite frankly. We are very quick in the independent mortgage society to attack each other. And there's been some very good posts. You've done one, KP, others have done one and said, hey, man, cool it. Because what someone does doesn't mean they're broke. It doesn't mean they're desperate. It doesn't mean they're stupid. But there are different levels of risk depending on how each company is structured and depending on what their capacity is, depending on what their current volume is. Not everybody's the exact same thing. So you are going to have outliers. You are going to have some that are slower to change on FICO, some that are quicker, some that have different models that say, look, we think we can predict who's going to go in forbearance, so we're going to change guidelines based on what that predictive value is. There's some that are going to say, look, we can't predict it, so we're not going to take any chances. It's the arsenic example I gave you last week. But if people feel they can do it, you've seen some say, look at government lending. Right now, let's take the securitization issue off the table. I mean, let's assume you can place these loans. Now you're back to the servicing issue and the default issue and the cash advance issue and the loss of economic revenue. Because one of the big issues is, remember, when someone goes into forbearance, forget about just the cash advances. The real question is, aside from the liquidity event, is will they pay after they come out of forbearance? Because remember, what we're paying for, whether it's a retail, wholesale, correspondent, is a servicing strip that's supposed to last X number of years. Past data suggests that when people go into forbearance, they don't come out very easily. And so one of the big questions on the table is, when people go into forbearance, given this is such a different event, will people succeed coming out? And so the servicing strip will continue. So is it only just a liquidity event or is it a profitability event? And it's two different things that people have to decouple, because it's two entirely different questions and two entirely different mathematic assumptions that need to be made, and all based on unknowns that have never been tested before. So it's not surprising that you have different people with different opinions, because the historical data isn't going to be particularly useful in this case.
So a couple of weeks ago, there seemed to be sort of a sign of relief from many independents about the pass-through assistance program that Ginny rolled out, which basically said, if you find yourself in a situation where customers aren't making their payments, we will provide this lending facility where you can borrow the P&I that you would normally be making to your investor, your bondholders, and we'll forward that money on your behalf. The language in that kind of didn't really get a lot of emphasis, that nobody really has talked about, is the fact that the directive from Ginny Mae was this has to be a last resort. So, how do independents, view that facility? Obviously, it doesn't appear to be the one size fits all answer that everyone was hoping for, because we have some other issues that have come up. But how's this?
Great question. And again, I would liken it to the day, if you recall, the day that President Trump got up in front on that, I think it was Friday, where he got up in front of his team, had businesses, private, everybody together, and had that great speech that was well received. The stock market jumped by 1,900 on one day. In the next 3 days, it gave it all back. You could argue this is kind of similar. Everyone did breathe a sigh of relief for a moment. It was a big win. It was nice. And to your point, they had language in there that is a little discomforting in terms of last resort. But what they did do is they put in language that said that you will not be in technical default. And that was the nice part, is that at least if you borrow the money, you're not considered in default, which triggers a whole bunch of other challenges. So it was still a win, to be clear. To answer your question, why is it still problematic, and why isn't all of a sudden MSRs back to to positive again? Well, remember, you still can't decouple the fact that nobody knows how well these loans will perform when they come out of forbearance. So remember, there's still an income stream. So forgetting about the liquidity piece, even if they solve for that, even if they solve for the fact that you can advance, which, by the way, isn't particularly solved for, because remember, when they say words like last resort, right, it's a little tricky, because let's say you start doing a whole bunch of Ginnie loans. It's very easy for them to say, well, wait a sec, we said last resort. Why are you still funding these? Like, I don't understand. Like, we understand why you need it for the loans you did have. But you could argue they may question you and say, well, why are you still funding loans with low FICOs? Why are you funding things that have a high probability of not paying? Like, why are you putting Ginnie Mae under pressure by doing loans that may not do well? So you get into this difficult question of, are we being irresponsible by even lending on government loans? Because Ginnie may say, hey, look, we said we'd help you on the loans you already have because we get it. You did those in good faith. But these new loans, look, you should have raised your FICO scores. You should have put a reserve requirement on there. You should have done certain things, because when we gave you a lifeline, that didn't mean rush and take it immediately. And so there's always strings attached. And I don't mean that meanly. That doesn't mean the government is not doing the right thing. But it doesn't mean it's a simple equation. And even if you take that piece out, you still have the question of, what will borrowers do when they get a forbearance plan? And how will these be written? And how will they be codified in terms of what are the odds of them performing after? Because even if you have the liquidity re-advance back to you, if they've never made a payment, if they go into foreclosure after, and they go into default early on a forbearance, then fundamentally, they've never made a payment. So paying out money to receive an income stream that isn't going to exist, aside from the fact that you have the liquidity event, even if it comes back, you still have other expenses, right? You still have default servicing. You still have the risk that something can go wrong. You still have some states where foreclosure is incredibly long. You still have the headline risk. Nobody loves to foreclose on people. I mean, you see the stats on foreclosures for the last 10 years. It's been very quiet since the crash. No one wants a moment where lenders get their money back through foreclosure, but it's not a fun process. It's painful. It's legal. It's unpleasant. And from a headline standpoint, it's not particularly enjoyable. And so there's still a whole lot of reasons why, despite the fact that there's this lifeline, there's still a whole long list of reasons why servicing for a loan right now is not a good investment, or at least for the moment is a mathematically difficult investment to prove. And no one wants to be on the wrong side of the math, essentially, is the issue.
Now, so we've talked a little bit about the Lakeviews, New Res, Wells Fargo's, the people that are the aggregators that essentially are the biggest buyers of servicing. For your correspondents and even your independents that will take on servicing for a short period of time, whether that's a couple months or a year, essentially these pass-through entities that retain servicing for a period of time, but they're not in the servicing game long term. How impactful is the market today? I mean, if you're relying on selling servicing or selling loans to a third party to fund your business and to operate your business, are you able to operate business as usual today?
Yeah, I mean, look, I would say that most companies are nimble to a degree, right? And again, it comes down to how nimble and for how long. And so fundamentally, yes, if a company is only servicing X%, and that's what they've done, it is unrealistic to think that they could change overnight for a long period of time. They can change for a period of time, but keep in mind, the beautiful thing about servicing is, even if you service for a while, it is not as if you can't sell it later. Like turning an asset, from cash into a balance sheet item and having a servicing strip. When this normalizes, you will have the opportunity to sell that again. So what you're really doing is saying, okay, the market is zero or negative, but we still want to lend. We still believe in this asset, but this is where you get into economic value versus liquid value. So just because something is worth negative, we have to believe some of the stuff will get cleaned up. Now, there will be clarity. And the truth of the matter is the credit environment is still very strong. And the people that are funding, at least up until today, in theory, most of them hopefully will keep their job, or if they lose it, they will come back to work. And because they have equity in their home, unlike the situation in 2007, the theory is this time people will fight through the house and keep it. And so it's not as if the servicing is worth nothing. It's worth nothing now because it's illiquid and it's immovable. But you can do this with the assumption to be able to sell it down the road. Now, if that's illiquid for a long time, And that's where when people say, and I've heard some people say, don't ever cheer for another company's death. This is why. There's only so much supply out there. And the truth is, we need independent mortgage bankers. We need the bankers. We need the government. We need the brokers. We need everybody. And in no one channel can exist alone without restricting consumer lending. It's just a reality. If you look at the rise of the mortgage broker, it is not that it wouldn't have happened, but it would have certainly been slower if it weren't for independent mortgage banks that have helped lead the way over the last 5, 6, 7 years. There's just no question. That doesn't mean the banks wouldn't have done it, but they would have slow played it to some degree. And they would have certainly lent credibly, but would that mean less credible loan officers in the industry? Would it mean less education for consumers? Would it have probably meant less options and choice for the consumers? Absolutely. And so that balance between being liquid as an industry as a whole versus giving people enough channels to support supply and demand are essential. And so could any lender carry it for a while? Sure, they could. Could they turn a cash asset into a balance sheet asset? Of course they could. Could they lend against it and get more cash? Could they? Could some companies have to join forces? Look, a million things could happen. But this moment in time shouldn't be the death of anybody. And everyone has to remember, this wasn't caused by delinquencies in itself. The delinquencies haven't even occurred yet. This was caused by free forbearance for all in a short window of time, meaning, let's say employment does drop to 10, 15, 20%, take some of the most dire predictions. People fight for their home. And let's say they start not paying. It will happen, but it would happen over 6 months, a year and a half. It'd be spread out over time. People would plan accordingly. What happened here is we took a 2 to 2.5 year horizon and basically said, here, in 10 days, figure this out and have enough capital to handle something that will happen in such a short period of time where people don't even have to prove a hardship. They just have to say, I want the free money. And so it's not that they were wrong. It's well-intended. It's like many things. It was well-intended, but they didn't think through the alternative liquidity issues that come with it and come with helping the consumer. And so I don't think in itself it is, when people talk about chaos, yes, it is chaotic right now, but with a few intelligent moves, this could solve itself. But to be clear, does it make everybody less liquid? Of course it does. When fundamentally you're relying on an income stream and you take it away and you allow everyone to not pay income, then by definition, of course it creates a liquidity event. And it doesn't matter who you are, it is going to force everyone to alter their model a bit until it subsides. That's just the reality.
So thinking through this, and obviously nobody knows how long this is going to last or what the complete ramifications are. What do you think the future, how does this impact the future of servicing? Because it definitely, Ginny was already on the warpath about liquidity and capital requirements when it comes to servicers of at least their securities. This clearly has put the issue into focus. So, how does this change, the future of servicing, whether it comes to how do you price servicing into your rate sheet, who's going to be able to do servicing, and all those different things?
Yeah, I mean, it's a great question because, so often we tend to close the gate after the goats have gotten out. And so, if one wants to price servicing based on the potential of pandemic, then yes, I guess you'd argue servicing is worth zero forever. Theoretically, servicing is a cash flow modeling of an income strip, minus your costs, minus some liability, and your ability to judge your return on equity for the cash you put out there. And really, essentially, you're dealing with prepay speeds, and you're dealing with performance and delinquency. And so it comes down to how reliable you think you can get back to that when this ends, right? And that's why I would say most people are still fairly optimistic in some respect, right? As unpleasant as this has been, right? If you look at kind of the Constitution of the United States, yes, we're coming off an 11-year bull run. The recession was bound to happen at some point. You had people pegged to predict it for this year or next year anyway, quite frankly. It was going to happen. And so unemployment was probably going to trick up a little bit. But the credit quality, if you look for the last years, has been fairly exemplary, right? The housing supply is fairly low. And appreciation has been increasing, but not crazily increasing. And so the truth is, we have people that have owner-occupied homes that want to keep them. We have housing formations that really over the next few years should continue to grow. So theoretically, right, servicing value, if you take this crazy disruption out, really should return to fairly normal levels. What you'll see probably, obviously, is now will people be obviously for a period of time be less willing to pay out full boat knowing that this kind of thing can happen? Will they set aside a bigger reserve for liquidity? Look, they will, but the truth is you can't necessarily reserve for a pandemic. I'm going to go back to the other example. You can't reserve for 20,000 people that all have to go to the toilet at the same time. No stadium is going to still build 20,000 toilets no matter what happens. And so there's still a limit. In other words, we're still going to operate with finite cash no matter what happens. So will you see requirements change? Possibly. But hopefully what people will see is there's a better way to react to a pandemic and a better way to work with community and government and the independent institutions and the banks to say there's a better way to spread this liquidity event out so it doesn't become so quick and so dire in such a short period of time.
So with that said, I sent you an article yesterday that I posted on my timeline. A little bit, both going over FHFA's, sort of influence over the current situation, a little bit of a conspiracy theory like tuned to banks lingering and favorability to banks versus independent mortgage banks. What are your thoughts on where the banks stand and do they want everybody to succeed? Are they pulling for this to be an opportunity? What are your thoughts?
Probably all the above, I suspect. I mean, I'm sure they don't want everybody to go lend to a lot of these people. So I suspect there's to be some issues there because many of them certainly have repo lines or commercial paper lines or commercial lines against their servicing piece. So I can't imagine they want anyone to really shut down. Again, the analogy I gave you, I think it was on our first call, so I hate to be redundant, but right, the analogy we gave, right, is again, if you give all these kids ice cream, you give it, kids are upset. So you say, hey, you know what, kids are upset around the country. Let's give them thousands and thousands of pounds of ice cream. Again, you can't say the hospitals are to blame because you didn't have enough ability to address diabetes for everybody you gave it to. And so, for the banks or the FHFA to say the independent mortgage bank isn't adequately capitalized for this, look, there's some truth to that. You're right. Independent banks have finite capital, but they also didn't ask for forbearance for all. They didn't create the solution. They didn't ask for it, and they would have altered. I guarantee they would have proffered a different solution if they were given the opportunity to do so. And so, do the banks like the fact that independent mortgage banks that may have taken on some risk that they didn't do over these years? Do they want to see them probably get some harm? Are they going to say some banks acted, arrogantly, and independent mortgage banks maybe were too little loud and they grew too quickly and they were a little reckless? Look, you can always argue about someone's growth plan, right? Because anytime someone takes a risk and risks their own private capital, you can always pass judgment after the fact. And so I suspect it's all the above. I can't imagine they'd want good independent mortgage banks to go down because I think, quite frankly, they make money off them as well. But do they want to show that their way and their path that was a little more conservative, that is less likely to have things go wrong when something really goes wrong? Certainly. So I think it's both, quite frankly, if I had to guess.
So, and just to finish up on that, on how the buybacks work for if you sell a loan to an aggregator. So if an independent mortgage bank, whether it's you or any of the wholesale lenders that are out there, funds a loan, then sells that loan to any one of the aggregators. And as it turns out, forbearance is requested before the first payment date, the loan's been securitized, whatever that mark, or that line in the sand is that they're putting out there. They notify you that you have to buy back that loan. You've now bought back that loan, and for the most part, that loan is going to be a tough loan to sell because it's got a forbearance existing.
Well, yeah, the reason they put it to you is the same reason because they couldn't put it out there. In other words, if they can't put it to the GSE, that's their obligation. So it'd be silly to think that we have a plan that they don't have, right? And so at a time like this, what you really do is this is where you don't get mad at your aggregators. You don't get mad at anybody. You try to work through intelligently the solution. And the solution is to, again, fund loans that we believe based on the most responsible VOE path we can have and based on the job they have. If we can satisfy Fannie and Freddie's continuation of income, and we fund a loan after satisfying that, and we can narrow the time horizon to when it gets securitized, whether that's us directly or through an aggregator. If you can agree on a very short cycle, then theoretically, one may say, well, you're passing it on to Fannie or Freddie. It's like, well, we're not really. It was their idea to do the forbearance. It is their program. It is what taxpayer dollars are for. So I don't think it's irresponsible to say, no, we expect you to buy an asset that we followed your rules for because that's what the program is. And so if you can shorten that cycle, it works out fine. So the answer is you work with aggregators that have a reasonable and quick cycle. And if not, you use your own cycle and you work with Fannie and Freddie directly. And again, you're just trying to shrink that period where a consumer can ask, Or, quite frankly, what you hope for is everyone says, well, forbearance means, quite frankly, after a payment is due, that means May 2nd. And theoretically, your entire March book goes away and there's no problem, right? This could be solved a lot of ways. It's just no one quite knows what's going to happen yet. And so everyone is now, for the moment, shortening the cycle until they get better clarity from the agencies and from the FHFA. I don't believe, when I've heard some people say, this is the banks, the FHA trying to kill the independent mortgage banker. It's hard to believe that. But as you know, my son's doing a show with HBO and it's about revisionist history. And one of the theories out there is actually that the United States let Japan bomb the US because that was the easiest way to get into a war they couldn't otherwise enter. Now, I don't believe that either, but it doesn't mean someone doesn't. So I'm sure there's going to be someone that thinks this is an opportunity time for the banks to try to create some kind of way of pushing out independent mortgage banks. It's just, to me, because I know how much money they infuse into the mortgage banks and support them, I just refuse to buy into that narrative. But that doesn't make it right or wrong. I'm just not a big conspiracy theorist kind of guy.
So I'm going to ask you the questions that we've been asking several executives that we've interviewed in the past. Now we're not going to hold you to it, but these are short and fast.
I don't want to compete with Barry Habib and Dave Stevens or any other guests. So I'll do it, but that's not fair. You should have intelligent guests that you've had. You should not have let me go last.
Do you believe we will see home prices decline, and if yes, by how much?
Again, I think there'll be an immediate dip because I think everything has a knee-jerk reaction. But fundamentally, I don't think it should be that bad. I mean, we have a record housing in terms of supply. It is incredibly low. We have way too few homes right now, and even though employment is going to shoot up, many of those jobs, and I think this whole V-shaped recovery, I think, is being overstated. I think it's going to be a little slower and more painful than people realize, but it will recover because we were coming out of a strong and healthy economy. And so I think they'll dip a little bit because of fear and trepidation, but the bottom line is interest rates are going to stay low for a long time. Housing supply is still going to be underserved for a long time. Housing formations are going to increase. And so fundamentally, there's no real good reason for values to drop other than a little bit of panic and a little bit of unsettling for the moment.
How do you, what is the biggest risk to the mortgage industry at this point, and how do you mitigate it?
I guess unlimited cash. Look, again, the GSEs obviously have a lot to do with this. We need to work with partners. How do you mitigate this risk is getting everyone to work together. I've actually served on a couple of boards that are charity boards that have done public partnerships along with private partnerships, and they're joined together. We're equal parts, both do fundraising, and they actually co-manage the properties. And I've done it in a few different places. And I think public-private partnerships work wonderfully. I think we're too quick to blame the government here, or blame this person there, or blame the consumer for not paying, or being too quick to not take the money, or blame the independent mortgage banker for this. The biggest risk is that people don't communicate. The biggest risk is when something happens, they blame the wrong thing, meaning, well, we can't let the independent be a part of the solution because they're a part of the problem. They're not a part of the problem this time. If someone wants to think that they were prescient in saying, I knew they'd run out of money at some point, so I created a world that made it unlimited money was necessary, that's not really fair. And so to me, the biggest risk is that everyone doesn't work together in a very short horizon that has been forced upon everybody and doesn't come up with an intelligent solution that benefits everybody. That is our biggest risk.
What is your number one priority right now?
I'd say sleep. That's out the window. You forced me to shave, so that's out the window. So then it's to watch my kid's show at 9 o'clock tonight, as a shameless plug to my child on HBO, which is now free for everybody, by the way. 500 hours free. So everyone
it's called Plot Against America on HBO.
No, to me, again, this is actually one of my highest priorities, to be honest, is trying to work with. I was texting Pete Mills feverishly this weekend. I was talking to Penny Mac executives this weekend. It's to set an example, to say, look, we will all get through this and there will be changes, and then communicate the changes and explain to the broker community and everyone else why some of these changes are being made. They're not because people are dead broke. It's not because the world is ending. But to be clear, is there a liquidity crisis? Yes. Could it get worse before it gets better if the right moves aren't made? Yes. If the wrong moves aren't made, could it shut some people down? Absolutely, it could. Should it? No, it shouldn't. And so the biggest priority is to educate, in the meantime, still run the company responsibly and try to make sure service levels don't get out of hand, right? Because people are forgetting, we're still dealing with record volume in all this, but record volume at a pipeline that's in the money when you have hedges that are out of the money, but yet wanting to fund loans that can pay, it's kind of a dual-edged sword right now. these loans are both dangerous to fund in some respects if they don't pay, but it's also dangerous to not fund them because you have a negative payoff position that doesn't go away. So unless you want to wait and hope that the market gets worse up until security date, that money is going to be gone either way. So you have a responsibility also to fund quality loans for people that have not lost their job and want to pay. And so it's just balancing it all out, which is really one of the most complex things we've probably ever been faced with in the mortgage space, to be honest.
How long do you think this will last? And we'll break this off and say there's the health part of it, and really the main focus for us is, there's how long does this impact, the unemployment situation, the short-term impact on the industry, and then what is the tail that's going to follow? How long is that going to last?
Yeah, I mean, great question. I mean, obviously the pandemic comes first in the health. I mean, that obviously it pivots everything. From there, you have the economic recovery. As far as modeling loans, it really comes down to the clarity on what can happen with these loans. Because again, you're dealing with a liquidity issue in terms of how do you price these out? And you first have a modeling issue. And so it really comes down to once people have, I hate to say it, but once people have lost their job and the loans you're funding left are people that have their job and it's an industry that's going to succeed and continue on, then theoretically those loans are back to their normal cash flow modeling, right? And so it shouldn't take too long, assuming this washes through over a few months. Now, again, there'll be, as you talked about earlier, there'll be some concerns from reserves, there'll be some stage fright and so forth. But theoretically, the loans from a performance standpoint should go back to normal once someone is going to continue to pay and doesn't need forbearance. Now, the other part of the contagion, though, is all the loans that you had up until now and what kind of losses you may take or what kind of advances you make, and will that lead to capacity constraints? And then the final piece, and when I say final, there's a million pieces, but your show's only so long, and you people are probably bored of me already. So I want
No.
But the last piece is still this modeling of will people come out of forbearance? But if you go back to 07, or if you look at a natural disaster, when you have a forbearance issue, if a neighborhood is blown up, a lot of times the problem is, well, they don't want the house anymore. They're done. They just want they want the check and they want to move on. They want the insurance money. They don't even want to be back in the neighborhood because it's been ravaged, right? If we go back to 07, they didn't even want the asset. It was a stock. It wasn't a home. It was a stock. They weren't interested. In theory, the last 10 years, people bought a home because they wanted it. And so the hope is that even if they need forbearance, which many people certainly do, is that they want this house. And so when it's done, assuming we can come up with an intelligent forbearance plan, right? Whether it's modification, whether it's a partial claim with an extension with a second lien that gets paid in full when the loan is paid off, whatever the plan is, if we can balance out their need to want to keep the house and get back to stability and they perform after, then even these servicing values that have been paid for get restored. So this is really about getting as many people comfortably through this in a way that balances out the fact that some people in the end can't pay their house, and that stinks, but it's going to happen, versus the ones that do, and very quickly trying to separate the two. And it's hard, but as long as that takes, it could take only a few months, but there's going to be, again, some portion of it that rolls on for quite some time before people truly get comfortable with their models. Because time, you need the time to know through foreclosure. If you're talking 6 months to a year, and then you find out if they're going to pay, you won't know that answer for a year from now.
Yep.
So you're going to have models that are difficult because how much do your new loans do you model in losses or other contagion from other loans? And so depending on what your book of business is and where you are concentrated, your pricing may be impacted. Even if you think the value is X of a new asset, you may have to pay Y because you have some recovery you need to do for the other assets. And it depends on how much you're willing to write off or lose, or how much you're willing to recover. And every company's going to have a different model, and they're totally entitled to do so.
What is your most optimistic prediction?
My most optimistic is that the FHFA and Fannie and Freddie say, of course, modification means that they have missed actual payment. And what we meant to say is that if they're already behind, meaning if you're sitting with a loan that you've been holding on for months and you hadn't placed into an agency security and they're behind, that is not the loan that you should be stuffing into a security. That is an irresponsibility. I mean, that's an irresponsible move by a lender. So if you funded a loan with Fannie and Freddie in good faith with the backing of the government, and you are part of their program as a Fannie seller servicer, it shouldn't matter when they ask. The answer should be, hey, look, as long as you operated properly and funded a loan with the intention of them paying and made sure they had continuity income, yes, you are welcome to put this loan in security. That solves a big portion of this. Then you get into the liquidity piece of the servicing piece. And then to your earlier points about Ginnie Mae, you come up with the terms, you come up with an intelligent way. They come up with a partial claim that makes the liquidity event not so long. And then ultimately the borrowers want their home, they make their payments, the servicing strip is restored, and everyone's happy. That is the most optimistic outlook.
Here's the last one that I've been asking everyone. I've constantly heard that this is unprecedented times. First time that people that have been doing this for 20, 30 years have seen this. What has been the biggest learning lesson or the biggest takeaway from you over the last, let's say 30 days as this has developed?
Look, I kind of talked about it earlier, so I hate to be repetitive, but again, it seems, I've always said, even at post 07, 08, is when something goes wrong, we tend to kind of ostracize the insiders or the business people that we suggest weren't equipped to handle the issue. And in this case, they're going to kind of put the mortgage bankers out there and say, well, you didn't have unlimited capital. And so they're not listening in my mind, or my fear is, I'm saying they're not yet, because I think it's too soon to even say if they're listening or not. But so the biggest thing I've learned all the way in this, and again, this only reinforces it, is that if the government is trying to solve a consumer issue, we can't villainify the banking community. And the banking community can't villainify the government, and the consumers can't villainify everybody. Like, we all need each other. It is the reality. We need independent mortgage brokers. We need independent mortgage bankers. We need bankers. We need the government, and we need consumers. And anyone who thinks otherwise is being, in my mind, a little bit too arrogant and is being short-sighted. And I think that when people make decisions to try to fix one thing without speaking to people and actually truly saying, look, can these people give non-self-serving answers that says, look, this isn't just best for us, it's best for everybody. And you have to find certain people that actually do that. There are people in this industry, in any industry, that will give answers that they really believe are for the greater good. Sadly, there are some that don't, and that's the truth. But this notion of painting everybody with this wide brush that bankers are bad or Wall Street are bad or this or bad, it's problematic, because at times like these, it leads to poor solutions because you don't understand the ramifications of the things you do. And you have to trust somebody inside the industry to help do what's best for everybody. And this is times like these, the trade organizations, the government, industry leaders, you can't talk enough, and they have to trust each other. And you got to pick someone you believe is going to give you good advice and honest advice, and isn't just telling you what's self-serving or what's best for themselves, or is trying to, is now a heathen because they made money all these years in the mortgage space, and now they're some bad person. Like, that's not fair to blame past success and question their motives and what's best for the industry and what's best for the consumer. And I think some people are, and that's the problem.
That's a good answer. So I think it all goes back to perspective and kind of taking a step back and realizing that these are times where you can't be on this take a position of defense all the time. You have to actually put the greater good of both consumers, the industry, and all these things before your whatever judgments that you have or past experiences you have with people.
Which is how you got me to get on Facebook for the first time. And you were, by the way, outside of my wife, my second friend on Facebook. So you are changing. You have got me to. I've been talking to you
for weeks.
I've been talking to you behind the scenes. I talked to Barry. I let Kate, great spokesperson for our company. I'm happy to let him be the social expert and leader. But again, I felt that with all that's happened in the last week, I finally texted you on Friday and said, "Man, put me on your show. I got," and I thank you for letting me do it.
Yeah, this is very important, valuable content. I think it's like I said to everybody in this group before, this is what's happening. And there's been a major disconnect for many years between what's going on in the secondary market and capital markets to what loan originators know and are hearing. And I think what we've tried to do is connect the dots so everybody's on the same page, because to your point, we all need each other and we all play a role. And with this forbearance issue, it's important that everybody understands the magnitude of the problem, because it will end up coming back to be everybody's problem. Whether you get paid a commission or a broker compensation, if the issue does come back on the lender, it's going to be something that we all have to deal with. And it's something that we need to be responsible, and we have to put the long-term interest of our partners and even our customers before the next transaction. So, I'm grateful for you, Gary. We appreciate everything you're doing, both with the MBA and within the industry to get us through this period of time. And we appreciate PRMG. Anybody out there, if you have an opportunity tonight, Gary's son, Caleb, is on Plot Against America, which is on HBO. Looking forward to watching it. We appreciate you, Gary.
All right. Thank you for having me. I really appreciate it. Have a great day. And I'm sure I'll talk to you within hours, I suspect.
Thank you, sir. Have a great day.
All right. Thank you. You too.